Good morning, everyone, and welcome back to another episode of Banking Matters. My name's Daniel Baker, and I'm your host. Joining us for today's episode, we have Scott Daugherty. Scott serves as the president and general counsel of Bankers Alliance. Through Bankers Alliance, he oversees Compliance Alliance and Review Alliance. Scott brings a combination of community and regional banking experience along with his legal expertise. Prior to going to law school, Scott enjoyed a career in banking with a broad background that includes retail and branch management and consumer and commercial lending responsibilities. After leaving retail banking, Scott has worked in a variety of capacities with Texas Bankers Association, including Startup of Compliance Alliance and Bankers Alliance. As such, he's one of the leading bank regulatory compliance and legal experts in the nation. Scott, welcome to our show today.
Thanks, Daniel. Glad to be here.
So I always like to start out these episodes by kind of asking, how did you get involved into the banking industry? I mean, it's kind of a unique industry. Most of the people we hear kind of just fell into it. What's your story? How did you get started in banking?
I completely fell into it. I graduated out of undergrad and was looking for a job and talked to a friend that said, hey, go down and talk to this bank. They're always looking for people for their management training program. So I did. For whatever reason, the bank's like, yeah, we'll put you in our management training program. So that's really, I needed a job out of undergraduate and was looking, and it just kind of came along. And once I got into it, really not understanding what the industry was like, I actually really enjoyed it.
Mm-hmm.
And just kind of stayed in it for a while. That was back in the crazy 80s when, banks were failing left and right. I've gone through that a couple of times in my career, but back then it was the S&L crisis going on. So I got to live through that, which was maybe a good way to get into the industry because you kind of saw the bad part right up front and knew kind of like, okay, we need to avoid these things going forward.
Yeah, definitely have a little bit of a transition there. Where did you do your undergrad, if you don't mind me asking?
University of Kentucky.
Okay, and then what did you do your undergrad in?
Actually, it was in marketing and advertising.
Okay.
Which when I found out afterwards, there's not a lot of job opportunities in that field. So that's why I started looking more broadly and got into banking.
Well, that's a little bit of a transition from like marketing and advertising on into the banking industry.
Yep.
Well,
yes, definitely different.
You brought up an interesting topic actually that leads perfectly like right into kind of what our first topic of today is, and that is banks failing. I mean, with Silicon Valley Bank and Signature Bank failing, there's a lot of questions and concerns, and we're going to really address the banks failing and kind of policy and procedures around that in another episode. But one of the elements that goes into that is really a bank's internal policies and procedures around audit and compliance. Scott, do you have a lot of experience with auditing and that side of things?
I've never actually done an audit, but I've gone through a lot of exams.
Okay.
So I'll answer that kind of with a non-answer. But, I think one of the things we're seeing right now is, the interest rate market being such as it is. We had super low rates, almost non-existent rates for banks for so many years. Some banks kind of took that for granted and kind of got lax in their interest rate risk and just risk profiles overall. And they would start buying long-term bonds that almost paid no interest, and then as rates went up, they realized they're really not in a very good position on those. And that really kind of comes down to managing the bank's risk. And had they been doing a good job of that, don't like to criticize bankers, but especially with Silicon Valley, had they been doing a better job of managing their risk and really looking at that interest rate risk that they had, they probably could have avoided some of their problems. I think they have many problems. Which I'm not intimately familiar with, but they had some pretty serious problems. But that was certainly one of those. We're seeing real estate lending is slowing down because of rates. The Fed's going to probably raise rates again. They haven't given any indication they're going to quit raising rates. Mortgage rates are going up, so people are not buying houses. That's impacting real estate, impacting realtors. It kind of trickles down. And I think for banks, their risk is how do we manage all of our risks? We know we have to watch for loans. We need to, do a good job of underwriting, but, then you got that interest rate risk. You got, We don't want to be too much long term. I can't imagine a bank in 30-year mortgages that they did 5 years ago at 2.25% and having that on their books for 30 years, because no one's going to pay that loan off early right now. I look at my own mortgage and I'm like, my rate's too low to pay any extra on it because it's almost free money now.
Yeah, just keep it.
I can literally put money into like a bond and make money over what my mortgage rate is. It's like, why would I pay extra on it?
Yeah, absolutely.
And I think that's a risk for banks that they have to really look at. One thing with the bank failures that we're seeing that I think is a bigger risk probably for community banks than the things that made those big banks fail is the regulators now are going to come in and be a little tougher on their exams. They're going to come in and really look and scrutinize to make sure that the community banks aren't falling into any of those same traps. And I think, the risk there is just that the regulators are going to come in and look harder at everything to try to make sure that the banks are in good, sound position. And I think the vast majority, I don't want to say all banks are in good shape, because obviously we've seen some that haven't been. But I think for the majority of the community banks, they're in really good shape. They manage their risk well, but they still have a risk in that when they have those exams, they're going to look harder at it because they've had, I hate to say egg on the face of the regulators, but they kind of have. And I think that's going to make them look a little tougher at everything when they come into those exams. So, if I was a bank getting ready to go into an exam, I would be worried.
So let me ask you then, how can a bank prepare for those exams? I mean, you should be worried going into an exam because the regulators are definitely like they're walking on eggshells per se because of everything that's going on. They're exercising extreme caution. How can you be prepared for those exams?
That's the hard part is it's hard to say, oh, well, we're going to go in there and do these things for the next 3 weeks to get ready, because it really is going to be going back, 18 months or longer, depending on their exam cycle. And it's hard to go back and undo some of that stuff. But, one thing that we're seeing more banks doing, they all have their internal audits and everything, but they're going in and doing more of we want a review of this area of our bank, and we want to see, like on lending or real estate or, overdrafts, whatever it might be. We want to have somebody come in and just do a review, kind of where are we in the program. That can help them self-identify any potential issues. So hopefully if they self-identify it, they're still going to probably get written up for it if they self-identify a problem. But if they self-identify it, fix the problem, at least then when it gets written up in the exam, it's like, well, yeah, we found this problem. The bank's already identified it. They've already put this stuff in place to fix it. So at least it's being done. While it might be noted, you've already fixed it, so it's not as bad as, well, we saw it, we knew about it, we just didn't want to fix it. That's bad, Also bad of, well, we just didn't even know we were doing anything wrong. So a lot of banks are starting to do those reviews of areas where they think there might either be an issue or they just want to double check to make sure there's not an issue. And having like a third party come in and just really do a breakdown of that area and scrutinize it and see, where does it stand, and then they can implement anything that might be a shortfall.
So then piggybacking on that, with implementing those processes and procedures and getting the third party in there to review, let's kind of give a hypothetical. Let's say you've got a bank, you're running it, you're the man calling all the shots. What are you going to do? So I mean, day one, you walk in and you've now got this concern of extra scrutiny, even above and beyond maybe a traditional exam. What are you going to do? What's going to be kind of your first step, and then what's going to be your process that you follow through to accomplish this goal?
My first step would be, find a good third party to come in and do that work for me. I think it's important to have it be a third party for those, partly because you can use your internal auditors, but they've already done your audit, or you can use internal staff, but they're more involved in the day-to-day. So this is kind of like, if I were go back to law school, when, I was writing my law review article, I could not edit that at some point, because I would read that thing over and over and over and see what I thought it should say, but not see what it actually said. So I could miss the most obvious misspelled word because I'm reading it the way it should be. And that happens with bankers. If you're a loan officer and you've been involved in these loans, you may not see an obvious glaring issue because you look at it, you may say, well, I know this customer, they banked with us for 25 years. They've never been even a day late on a payment. But if you actually look at the financials, you may say, well, they're actually, there's some trouble signs here that I ignored because of the history, where a third party knows nothing about that customer. They're just coming in and looking at the code hard data.
Yeah.
And I think that's important sometimes because you take out the human element. Now, as a banker, I say you need that human element because that's part of how you make good decisions. From a examiner review type position, you're taking that out and just looking at the code hard data, either the numbers line up or they don't. This comes into play with redlining and CRA and overdrafts. So many banks have gotten caught up on overdraft because they're like, well, we know this customer. Well, that doesn't mean that you should pay their overdraft and not this other person's just because they come into bank every week. That doesn't change that. So I think having that third party come in and really review that, take out the human emotion part of that and the relationship part. And I hate to say that because I think relationship is all what banking is about. It's all about the relationships. But I think from prepping for an exam, you have to take that out and look at it. How's an examiner going to look at this? So, I think going in and looking at overdrafts, looking at your loans, all those kind of things, and just really kind of breaking it down and saying, have we treated every customer the same? Because that's super important. Do we have any where any exceptions should really be scrutinized? Why did we make this exception? Did we document it? If we didn't, let's go back and document why we made an exception to our policy. Why did we not make an exception to another borrower or another customer that would be similarly situated? Why did we make it in one and not the other? Because those are the things an examiner is going to look at. Like, okay, here's your exception list. Why did you make these exceptions? Why didn't you make them for other customers that might have been similarly situated?
So really what I'm hearing is that third party and then like just scrutinize every detail and kind of walk through step by step. So then how do you select that third party? I mean, there's tons of different companies out there. I mean, Compliance Alliance and Review Alliance, right? We have our own third parties that Review Alliance offers on their side of things. But how do you select a review or a third party? Like, not even necessarily talking about Review Alliance. Like, what are you looking for? What are you trying to find?
For me, the important things would be, that it's somebody that understands banking, that's been a banker. Because I'm a firm believer that bankers know more about banking than non-bankers. And, when we start talking about examiners, they're often not bankers. And some internal auditor or external auditors that come in are not bankers. They haven't been a banker. Now they can come in and go down a checklist and, they can get out their exam manual and say, okay, I'm going down and checking off A, B, C, D, but they don't actually understand the business of banking. So to me, if I'm a CEO of a bank, I want someone that's been a banker, that has sat there and understands the issues, understands how policies work, why there are times when exceptions are okay and should be made, and kind of understand that piece. So that is my first thing. Is I always want to look for, has this person actually been a banker? And if they've been a banker, how long, were they in for 6 months? Did they do an internship, or were they a banker for, 10 years? Because to me, that banking experience is very important when you're going in and trying to scrutinize an area, because you could go in and say, well, you paid all your overdrafts, you have up to $500 for every customer. That sounds great. Well, what order did you pay those checks in? There's all kinds of other things that come in. Did you pay on this one, group of people because you also banked the employer and you knew that their paycheck goes in on Friday. So on Thursday night, you went ahead and paid those checks. There may be things there. And as a banker, you understand some of those to dig deeper, because on its face, it might look like it is an issue or could be a potential issue. But if you have to dig a little deeper then to find out, is it really an issue? And I think that's what trips up some examiners or people doing reviews, is they don't take that extra step of digging to find out why. They just say, okay, this on its face looks like an issue. And we saw this a few years back with surnames. We're gonna look at your minority borrowers and we're going to decide if they're a minority borrower based on their surname. Right. I live in Texas and have for 25 years, and you cannot look at the surname and determine what
you cannot.
Race or nationality someone is. You could have a woman with a Hispanic surname because they married a Hispanic. You could have, a non-Hispanic that has a, surname that looks like they're Hispanic or not, just really, you can't just look at that. So we ran into this with regulators where they weren't taking that next step to look at why. And that's where, bankers had to educate the examiners of, you can't just look at the surname and say, well, look, this list has paid a higher rate than this list. One, there could be good reasons. Is it a secured loan, unsecured loan, a car loan, CD loan? What kind of loan is it? But even going past that, are these folks really minorities? And, that's that extra first step you have to make of like, well, we know this person, this is a, white male, yeah, they may have a Hispanic surname, but, they don't identify as Hispanic. So, you have to look at all that and go that extra step. And they didn't do that. They just were like, oh, we're just going to take the surface and not go any deeper. And bankers had to sit down with the examiners and say, here's what you have to look at. Here's a list of our borrowers that you have on this list. We've identified the ones that are Hispanic based on either how they identify or how they've answered the questions. This other group are Caucasian, and then looking at it and saying, well, our list really doesn't look too bad when you separate them out on actuality. And unfortunately, that costs banks money to have to sit down and do that training with the examiners of, teaching them like you really do have to go deeper than just a surface level glance. That's what banks have to do. And I think that's why it's important to have that third party be a banker so they can do that next step. Because as a banker, you may have to do that with the examiners. So if they've done that work for you, when you sit down with the examiners to explain to them why it isn't a violation, you've already got the homework done. And they've done it for you. So it makes it a little easier to say, here's all of our documentation. This is why it's not a violation.
Yeah, and it definitely makes things easier when you've got someone that has that experience of having already been in branch and everything. So with the hiring of the third party, a lot of these third party groups and organizations are remote. Like they're not going to be coming into the branch, not going to be coming into the office. If they do, it's not going to be on any kind of regular basis. How do you manage a vendor like that? How do you manage a third party like that? How do you yourself? So let's say it's your bank. Do you yourself manage it, or do you farm that off to another staff member? What would you do?
I think depending on the size of the bank, the CEOs at smaller community banks are going to be involved in it, but they're more than likely, even at a smaller community bank, is going to have a liaison, whether it's their compliance officer, is who usually gets that job. If they don't have a strong compliance officer, it may be like their cashier, or if they have a operations officer, but usually it's going to be your compliance officer that does that, and it kind of act as that liaison. But the reporting should get up to the CEO because they are going to be talking to the examiners. I don't think managing the remoteness is really an issue. The way technology is today, they can VPN into the bank and see all the records they need to see. They can have read-only access. They can access all the loan files and everything that they would need to look at, just like they were in the bank. So being remote really, to me, is not an issue. And in some ways, it's better. One, it's not taking up staff time of them being in the bank. They're not having to pay travel expenses. There's a lot of cost savings for the bank. And from the person doing the review, it really doesn't matter to them where they're sitting as long as they have access to be able to go in and just access the files. The downside to it is, you're not being able to have the same conversations as if you're in the bank. But we're also seeing exams be done more remotely than ever before. So the examiners are doing the same thing. You can still have those conversations with people, by Zoom or otherwise, still have those conversations like you would if you were in the bank and see them in the hallway. You can still do those. You just have to kind of plan it a little bit more.
Yeah, I actually didn't realize a lot of the exams were transitioning to remote. I mean, working on the compliance line side, I don't touch much of the exams. So that's actually really interesting that they're switching more to remote, and it makes a lot of sense, especially with the transition from COVID and everything to a more remote based.
Yeah, and COVID kind of kickstarted that, because during COVID, banks weren't having people come in, including examiners. FDIC, OCC, the Fed, at least those. I don't know about the CFPB because we don't really deal with them as much. But the other regulators had a ban on travel. They weren't allowing their staffs to go in the banks. So the only way they could do an exam was remote. And what they realized is hey, we really didn't miss much by doing it remote.
Mm-hmm.
From the FDIC standpoint, it's better for them if their people are not, having to travel as much. Now, some of the staff people don't like it because they got a per diem. They got paid like a daily per diem,
Right.
which was kind of extra money.
Yeah.
Because I know a lot, especially the younger examiners, would kind of use that to supplement income of like, well, I'm getting $65 a day per diem, and then my hotel room's paid. And I stay at a hotel that has a free breakfast and they have snacks at night. So I really only have lunch that I have to take out of that money. So I think for them, it was a little bit of a pay cut. But, from the bank standpoint, it also saves money because they pay those travel expenses. So again, it's a win for the bank by doing that.
Yeah, absolutely. I do want to give you the opportunity to kind of talk about the VCO side of things, because I mean we've touched a lot around it. Your responsibility in your position as president over Bankers Alliance, you have a lot of virtual compliance officers that kind of fall under your umbrella. Tell me what's
Yeah.
unique and different about the Review Alliance side of things.
I think the most unique part of this is, this isn't something we set back in our office and said, we're going to start this and banks will love it. We really started because a banker came to us and said, I have a problem. My problem is my compliance officer quit, got hired away by another bank. She left, at this point, it had been like 6 months. They'd been without a compliance officer, which is a problem. They couldn't find anyone to hire. They couldn't even find anyone to interview. So that's how we started the program. Is the bank had an opening. They couldn't even get anyone to interview. As in rural East Texas, no one wants to move there. No other banks in the town that they could steal from. So we kind of came up with a plan, talked to the CEO, talked to the OCC, and said, this is what we're looking at. Regulators were like, well, we like it on paper. We need to see it in practice. The CEO's like, that's good enough for me. We started it and it just kind of took off from there because banks are losing compliance officers. It's hard to find new ones. You're kind of can become into a competitive, like, okay, I'm gonna have to pay more than the other bank just to steal them away, which has caused salaries to go up for compliance officers. Great for the compliance officer, bad for the banks. So all the compliance officers kind of like that because it's like, well, we're making more money than we used to because we're in demand all of a sudden. But we started it for that reason. It really was to fill a need for community banks that really were struggling with their staffing, or they might identify somebody within the bank and say, we've got this good young person that we think would make a great compliance officer, but they don't know anything about compliance, and we don't have anyone that can train them. So we actually have gone in and trained those people. We've worked with a few banks for, a year, 18 months to teach that person how to do the job of a compliance officer, how to do daily monitoring, what to monitor, how to write the reports, transaction testing, walk them through literally how to do their job, how to write the reports for the management team and the board, how to submit those to the audit committee, how to lead the compliance committee, all that, just basically teaching them how to do the daily job of a compliance officer. And that's an option for a bank if they've got a good person that they think would make a great compliance officer. They can look to someone to train them. I always recommend, send them to your state, whatever your state association is. If they have a compliance school, send them to that. It'll give them a job, kind of a broad general overview. It won't actually teach them the day-to-day how to do the job. You're going to have to find someone to come in and do that piece of that for you. But, we need more compliance officers. There's just not enough to go around. So what we've seen is with our virtual compliance officer program is we're filling that need for banks. And sometimes it's an ongoing, we've got banks we've been working with since we started the program. Others come in and use it for a year or two to kind of stopgap until they get somebody trained up or hire somebody, because they may be, well, we're going to try to hire somebody, but until we can, we want to have you in place. Sometimes that turns into a permanent thing because they're like, well, we've tried to find someone, we just haven't been able to. Some banks, grow and they get to a point where they feel like they're big enough to where they need to go out and hire somebody, and we've had that happen. We really are just here to fill that need for the banks. If you need us to come in and fill a, stopgap it until you get someone hired. If you need us to train your person, we can do that. The great thing is we've got some great people as our VCOs. They are all CRCMs, over 10 years experience, several with advanced degrees, former regulators, law degrees. We've got a very impressive array of VCOs that can come in and help those banks. We've been doing it long enough. We've gone through exams with our VCO program. All have come through. We've taken on banks that are under MRAs, memorandums, or matters requiring attention, or memorandums of understanding where we need to go in and fix that.
Mm-hmm.
And we've been able to get the banks out from under either their MRA or their MOUs.
Awesome.
So, we've gone into where banks are in trouble and got them out from underneath that to where they got a clean slate. We've had banks send us emails saying, we just came out of our exam. We got our best rating ever. We won't talk about what those ratings are because that's confidential, but they've told us, we got our best rating we've ever had. So it is filling a need for banks and has been very successful both for the bank and with the regulators.
So actually, as you were talking, and I really appreciate you sharing the effectiveness of some of these programs, another thought came to my mind that I wanted to pick your brain about, and that's, what if you disagree with an auditor? So, we talked a lot about hiring a third party, getting the review. And at the end of the day, they have to submit the report to you and you see that and you review that. And what happens if you just think they're wrong? Like, what do you do? How do you handle that?
It happens. It happens in exams as well. The good thing is if it's an audit or a review, typically the bank has a chance for a management response. Mm-hmm. So if you have an internal auditor come in and they are going to write you up for something, you get a chance to respond. Mm-hmm. So you can then go in that response and say, we disagree with this, and here's why we disagree. Here's our documentation. Here's our reasoning. Now, let's say it's an internal audit or even an external person coming in and doing the audit, and you disagree with that. Now, when the examiners come in, they're going to see the audit report and they're going to see your response. Now, for the examiners, they're going to look at that and say, is this a problem? Is it not a problem for us? But again, when you're done with that, they're going to give you their report, but you do still get a chance to respond. Even if like if a bank's under MOU, they get a chance to respond. They're going to get, questions asked and they have to respond to those questions. So they get a chance to explain their side of the story. Okay. But, I think with the audit piece, the management can disagree. If they can't convince the auditor that it's not an issue and they're insistent that they're going to write it up, they still get the chance to do their management response to explain mm-hmm. their rationale and reasoning. And, we tell compliance officers all the time, you may disagree with your CEO and they're going to do something that you're advising them, don't do this. Mm-hmm. This is a bad idea. The CEO is paid to make that decision. You're paid as a compliance officer to advise them. But what I always say is, it's okay if they decide to go against what you think is best, but document that you explained to them the risks, they knew the risk, they evaluated the risk, and then why they decided to go ahead and do it. Because then if the auditor comes in and is citing that loan, you can say, well, we thought about all that. We looked at all that. Here was why we still made that decision. And the same thing with the examiners. You can kind of document, this is why we made that decision. Maybe it turned out to be the wrong decision, but, hindsight's 20/20. You can't go back and say, well, every loan that you wrote off was a bad loan. If it was a bad loan when you made it, you wouldn't have made the loan. Nobody knowingly makes a bad loan. So it's one of those, if you document it, and the same thing with exceptions, document why you made the exception, do it when you're doing the loan because it's easier to remember, it's fresh. But again, the auditor or examiner is looking at this with no emotion. So they're looking at cold hard facts and not taking into account any of the human elements. So that sometimes is the reason. It comes down to long-term customer, good customer, always paid me on time. That's why, it was a borderline decision. That's why we made the decision. Yeah. But again, documenting it is the key.
Yeah, and that makes absolute sense. As you stated, like a compliance role is to raise the flag if there's a concern, and it feels like the compliance is your job is to identify all the risks, and then you leave it to those higher up the food chain to determine what business decisions they need to make and determine the cost versus worth and everything. So that makes complete sense to me. So we are running a little bit out of time, and I know we could just talk on this probably for for an hour or so more. But I wanted to give you an opportunity. If you had one piece of advice, it's a tumultuous time in the industry. There's a lot of questions going around. There's a lot of what if this happens? What if that happens? Is the market going to crash? Like what's going on? If you could give one piece of advice during this time to the banks listening to this podcast, what would you say?
It's it's hard to say here's the one great piece of advice, but I think what I would say is, again, and I hate to harp on relationships, but it really comes down to the relationships. For our community banks, they are ingrained in their communities. They know their customers. I think maintaining that communication with their customers is key, because what we saw with Silicon Valley and some of the others is it while they had some trouble, part of what caused their problem is their customers don't really know them, or they don't really know their customers, and they're kind of got a run going on their deposits in our communities, because we know these people. We're in Kiwanis and Rotary and go to church with them, and our kids play ball with them. We know our customers a lot better, but keeping that open communication of what's going on. If any customers have any, like, is the bank safe? Is my money safe? Having that conversation with them.
Mm-hmm.
I think it's really important, that banks understand how FDIC insurance works, and that they can explain that to their customer. And I'm a big fan of using the ED calculator that FDIC has, because you can put in ownership and POD beneficiaries and everything and show the customer, look, this isn't me telling you all your money's safe. This is coming from the FDIC showing, like, if you set your accounts up in this way, this is how much your coverage is. And I think showing them that to help eliminate those concerns of customers, because right now people have a lot of questions. First, is my money safe? And that's the biggest thing for everyone is the bank. If the bank fails, that's bad for the community, but really what they care about their money. But showing them, this is how the FDIC insurance works, and showing them how to keep their money insured, and letting them understand how the bank is run. And our board of directors, these people are well known in their communities. I think that's key. But just having that open line of communication with their customers, and being out there. You walk into a community bank and you can see the CEO in the lobby talking to customers. You don't see that at the really big banks.
Right.
And I think that's a big difference. And like I said, we do deal, with a lot of community banks where they do have those relationships. So I would just say, communication, as far as from the internal bank stuff, just making sure, your policies and procedures are buttoned up, go in and make sure, your interest rate risk is in a good place, that you haven't let that slide a little bit. And just, kind of making sure you're following all your internal policies and procedures, and like I said, communicating with staff so that they can communicate with customers as they come in, which means your tellers are your main communication with customers. Mm-hmm. So it's also making sure that they know what to say to the customers about these things.
Yeah, and I have complete respect for that. My back in my banking days, it was much the same, where we would pull up the ED calculator, and we would even plug everything in, and we'd print it off, and we'd hand it to the customer whenever they had a question about FDIC insurance. And having that relationship, the ability to just develop that relationship with your customers, I think is an essential skill in the banking industry, because times have changed. It's no longer just about the numbers and everything like that. People want to have that relationship with their banker and then their branch. So I really respect that. Thank you, Scott.
Yeah, absolutely. Sure.
Well, Scott, thank you very much for joining us today's show. I've really enjoyed being able to kind of pick your brain about auditing and the compliance and compliance officers and the roles in today's environment. So thank you very much for joining us.
Thanks, Daniel. Thanks for having me.
For the rest of you, thank you for chiming into today's episode, and that's Banking Matters.